All right, welcome everybody. It's noon, and this is our second part of our four-part series of first-time homebuyer seminar. This is recorded, and it will be available later on YouTube. So I want to welcome Jenny Jones and Michael Foley. They are presenters today. I'm Shelby Kimball. I'm a realtor and broker. I'm the immediate past president of the Greater Fort Worth Association of Realtors, and I will be moderating today. And if you have questions, you can raise your hand or put them in chat. We do have a section at the end specifically for questions. So if you want to wait and see and listen to all the information presented, your question might get answered. So with that, Jenny Jones and Michael Foley, they are experienced loan officers. They are very involved with Greater Fort Worth Association of Realtors as affiliate members. And I am going to turn it over to them now.
Hey, thanks, Shelby. Appreciate it. Are you guys going to put the PowerPoint up on here to reference, or? I can't hear you.
There we go. There we go. Here we go. There it is.
That. All right, guys. Well, thanks for having us. Jenny and I are excited to kind of go over a few topics. I know we don't have a bunch of time, but what we did was kind of pick out what we thought was most important for first-time homebuyers in the steps leading up to buying a house. We're also going to touch on some of the things that happen during the loan process. And then, like Shelby said at the end, we'll take some of your questions. So the first topic is credit, right? How does credit impact my loan approval? We started with this topic because usually that's kind of the biggest question we get is, you know, hey, I have good credit, I can go buy a house. So let's talk about credit, and then we'll talk about some of the other things that you need to have in order to give yourself the best chance at getting approved. So scores. Credit scores are important, but they're not everything. Credit scores can impact the pricing of the loan. They can also impact the approval, but more importantly, it's going to help dictate, you know, what kind of interest rate you get, which will ultimately affect what that monthly payment looks like. So credit scores are very important. So make sure that you, leading up to buying a house, you get your credit scores in order. The next thing we look at is capacity. So what does that mean? That means how much debt do you currently have? So we're going to look at everything that reports on the credit report, things like credit card payments, car loans, student loans, things like that. We're going to see how much debt that you currently have, and then make sure there's enough room in there for the new mortgage payment. That's the capacity. And then we look at credit history. So really what a credit score is your predictability of future default, right? So you're going to want to make sure that you've been making your payments on time, you know, that you've handled some credit in the past, because as they lend you this money, they want to make sure that you're going to be able to repay it. So they're going to look at the pattern of how you've been paying things, make sure you're paying them on time. Moving forward, that's going to help. All those things, those three things are going to impact whether or not you can get approved for a loan. Okay. The next part we want to talk about is down payment. So Robert, if you could go to the next slide. One thing we get asked, or a common myth, is when it comes to down payment is you need 20% down, right? And so we wanted to squash that. That's not the case. It certainly is nice if you can do 20% down because you avoid PMI, which I'll go over here in a second, but you don't need 20%. And Jenny's going to talk about specifically some first-time homebuyer programs on the next screen. If you do 20% down, what you avoid is called PMI, which is private mortgage insurance. And basically what that is, it's an added insurance that protects the lender in case you guys were to default on your mortgage. So if you think of it this way, if you don't do 20% down, if you do 3, 5, 10, 15% down, there's going to be a little extra portion of your payment that goes towards paying that PMI. And depending on what loan product you choose, whether it's an FHA loan, a conventional, that's going to vary. Okay. Going back to credit with conventional, if you have good credit, that PMI won't be as expensive. With FHA, it's always on there. It's a set amount. The good news with VA loans, if you're a veteran out there, is you can do a 0% down payment and there's no monthly PMI. So VA loans are fantastic. If you are eligible for VA benefits, make sure you ask your loan officer about a VA loan option when you're applying for the loan. And the one thing I wanted to mention was, we talk to buyers all the time that have budget or have money saved up for down payment. But what I wanted to remind you guys is there's other expenses when you're buying the house. It's not just down payment. You also have closing costs. So there's other expenses, whether it's lender fees, title fees, appraisal cost, and then creating an escrow account, which is money set aside for taxes and insurance on the property. There's going to be some other money on top of down payment that you're going to need to have saved up and budgeted for. So be sure when you talk to your loan officer and you go through that first initial loan application, you get a breakdown or an estimated closing cost worksheet that goes over what your total out-of-pocket expense is going to be. Because when you buy a house, everything's out of pocket, right? It's not like a refinance where you can roll some fees in, or that's something that, we always get asked too, Jenny, is, can I roll closing costs into the loan? The answer to that on a purchase is no. You do have to bring everything out of pocket. So make sure that you guys are budgeting for that down payment plus a little extra for the closing costs. I'll kick it to you, Jenny.
Okay, perfect. So kind of adding on to that, the first-time homebuyer programs, Robert, if you'll move to our next slide. There we go, perfect. So there are programs that offer as little as 3 or 3.5% down payment for the loan. So as Michael mentioned, those will come with a form of mortgage insurance, but it's a great way to get into a house. So it's, we don't see a lot of people, a lot of first-time homebuyers with that 20% down. So it's not uncommon for you to put less than that down. That's completely fine. And we have these programs. The state of Texas, this program that I listed here, the TSHAC is what the acronym that we call it, that they have a great website that goes through a lot of the first-time homebuyer assistance programs that they have. So those programs, they come in the form of either a grant, which does not have to be repaid. There's no repayment, no monthly payments made on it, or they come in the form of a forgivable second lien. So what that means is that as long as you live in that house for 3 years, then that second lien amount is forgiven, 100% forgiven. So it does have where you have to live there for 3 years, but it's a great option for you if you need some money to help bridge the gap. So like Michael was saying, a lot of times people will save up their money for the down payment, but those additional costs for closing costs and setting up your escrow account can almost double sometimes what your down payment is, the amount of money that you need. So these programs can be a good option to bridge the gap. They're not going to cover everything, but they can help. So the programs, they have a 3%, 4%, and 5% options. The program does set the interest rates. So typically those interest rates are going to be a little higher than the market rate, but in exchange for the little higher interest rate, you are going to get that assistance. The other two things about the program is that it does have an income limit. So right now in Tarrant County, as of October 1st, 2021, that income limit is $101,000 as combined income for any borrowers on the loan. So that would be if two people are buying the house together and you both are working, then we would combine that income to determine if you are under the income maximum. And then they also have credit score minimum. So the credit score minimum is a 620 for the loan programs for those options. And then one of the good things about that program too is that you don't have to be a first-time homebuyer to take advantage of it. The way that the guideline reads is you cannot currently own another home. So you may not have another home or another mortgage in your name to qualify for this program. The other thing is, as a first-time homebuyer, kind of what determines you to be a first-time homebuyer for traditional loans is if you have not owned a house in the last 3 years. So if you have not owned a home in the last 3 years, you could put as little as 3% down on a conventional loan without using the down payment assistance programs and take advantage of current market rate for that option. So then we'll move on to kind of the next screen is talking about what's the difference in being pre-qualified versus pre-approved. You've probably heard, if you've ever talked to a real estate agent before, they say, well, have you talked to a lender? Are you pre-qualified or pre-approved? So what that means, the true difference between the two. So pre-qualified means you've talked to a lender, they've pulled your credit to make sure you meet the credit requirements, and you have verbally given them information about your income and your assets. So they can determine from that conversation and reviewing your credit report that you are pre-qualified to go buy a house. The pre-approval is actually a step farther that says we've pulled your credit, but instead of just you telling the information about your income and assets, you've actually provided documentation to show your income, to show your assets, so that we can confirm the information that you've told is correct, as well as we've run your loan through an automated approval system. So there's a couple different systems that we use for different loan programs, and they give a decision that is an automated approval that says, yes, this is approved the way the information is provided. So, the big question is, one better than the other? Well, a pre-approval is stronger because we've actually reviewed the income and reviewed the assets and have that automated approval. It's a stronger approval for you to go buy a house that should have less surprises throughout the process. That's the goal. Our goal is to make sure that what we talk about up front and what you submit your offer on is what actually happens and get to the closing table. So technically, in this market especially, being pre-approved is really important, because as there's multiple buyers looking at the same property, or could be multiple buyers looking at the same property, you want to have the strongest approval. And we want to convey that to the seller that you're ready to go and you've actually taken all of the steps to be serious to buy that house. Michael, on to you.
All right. So one question we get asked all the time when we talk to buyers is, how much do I qualify for? What's the max that I can get approved for? And it's kind of a tricky question, because more often than not, and Jenny, you probably experience this, we can approve people for more than maybe they want to pay back monthly. And so the formula that I kind of use is, what's your monthly payment goal? Okay. Like, good question is, how much do you pay now in rent? Right? Because if you're paying that in rent, what your other expenses are that you have, monthly, car payment, entertainment, et cetera. Is that comfortable? Or can we stretch that a little bit? And then what we do is we kind of reverse math that to come up with, a sales price. And that'll give us a range. But really, it's kind of fluid until you guys go out and you actually start house hunting and find a specific property. And a big part of that, especially here in Texas, is because of the property taxes. So we're going to talk about debt to income ratio here in a minute, but part of what goes into your qualifying for the mortgage is the total mortgage payment, which is going to include principal and interest, which repays the loan. It could include the PMI that we spoke about earlier, but it's also going to include the property taxes and homeowners insurance on that house. So property taxes in Texas can vary. You cross one freeway and you're in a different neighborhood, and the taxes could be a little bit higher than on the other side of the freeway, right? So what we do is we kind of use general place fillers for those property taxes, estimated taxes, if you will, when we do the pre-qualification. And then once you find a house, then we can be much more accurate, look it up and give you what that estimated payment is going to look like. So when you come to a loan officer and you ask, hey, how much do I qualify for? We're probably going to ask you back a few questions to make sure that that price point and what that monthly payment comes out of that is going to be comfortable for you guys. Not only can you qualify for it, but is it going to be within your budget that you guys have set? Another thing that gets factored in is HOA dues, or homeowners association dues. So if you do go out and you buy a house that's in a HOA, that fee monthly is also calculated in your qualifying. Reason for that is, if you don't make your HOA payments, the HOA can actually foreclose on your property. So make your HOA payments. So whatever that amount is monthly, we factor that in as well. Look out for condos. If you are looking at condos versus single family houses, condos carry a much larger HOA fee because they have amenities. They take care of the common areas, the landscaping, they have a pool usually, that type of thing. So if you go from a $30 to a $50 a month HOA fee on a house to $300, $400, $500 on a condo, you might not qualify for the same sales price. So definitely have a conversation if you guys are looking at other types of properties, 2-unit, things like that, other than just your single family residence. And then your loan officer can give you an idea for about how much you qualify for. And keep in mind that number, again, can be changed. What you want to do is, Once you start house hunting and you find something you like, send it to that loan officer, make sure it checks all the boxes. They run it through that automated approval like Jenny spoke about, and that you're good to go. One thing I probably mentioned twice now is something called DTI, or your debt to income ratio. Now, that basically is calculating, okay, all the debt that you have off your credit report, plus what this new mortgage payment is going to be, divided by total income on the loan. So we take your gross income, so before taxes, we divide it by all the debt and the new mortgage payment, and it gives us a percentage. And each loan program is going to have different parameters on that, whether it's a 45% max debt ratio or a 55% max debt ratio. Plus, it's not the same for everybody. And what I mean by that is we go back to credit history, credit scores. All that is going to go into this total scorecard kind of calculation when we run it through automated underwriting, where it's going to tell us yes or no. So it really isn't the same for everybody. It's really specific to your situation, your income, your debt to income ratio, your credit history, your credit score, how much down payment you have, how much money you have in the bank. It's going to take a look at the whole thing and let you know whether or not you're approved at that price point or not. So have that conversation, tell them what you're looking for. We can take that information, make sure your debt to income ratio is in line, make sure we get your automated approval, and then come back to you guys with a yes or no on that. All right, so you're pre-qualified, you know how much you qualify for, you found the perfect house, you get into the loan process. One thing that you may or may not be familiar with is what the heck is an appraisal, okay? And the reason we want to talk about it is two things. One, why it's required. So a lender is going to require an appraisal because they want to make sure that that home is worth what it's selling for. The long story on why they need that is in the odd situation where the borrower were to default on the loan, they will foreclose on the property, the bank takes it back. They want to put it on the market and be able to sell it for what you just bought it for so that they can get their money back, right? So they basically want to prove that that home is worth what they're selling it for. And the way they do that is they send an appraiser out there. He's going to take a look at the property. He's going to see how many bedrooms, how big it is. And he's going to go look for comparable sales that have recently sold that aren't too far from the property and make sure that it lines up with what what has been selling. That's the appraisal. That's the only part of the loan in the loan process that you pay out of pocket. So your lender is going to ask you for a credit card. We're going to order the appraisal, and then the rest of the funds to close, they're brought once you actually sit at the signing table. So I always like to bring that up, that it's not uncommon for them to ask for a credit card to order the appraisal for you guys, and that's usually done. Which, I'll talk about that now, is that's usually done once you're out of option period. And so your realtor will walk you through once you find the house and you get your home under contract, and you have something called an option period where you probably do a home inspection and make sure everything's sound on the property and that you still want to buy it. And then at that point, that's when your lender will order the appraisal, because we don't want to order the appraisal, spend your money unless everything checked out or there's no repairs needed on the property. So it's usually done after that first week or so in the loan process. Right now, because just the market is really, really busy, the appraisals can take 1 to 2 weeks. And Jenny's going to walk you through the loan process and how long that takes, but it's usually a 30-day process. So, and the appraisal can take up to 2 weeks. So you want to try and order as quickly as you can. Once you know that everything's okay with the property checked out from the inspection.
Perfect. So once that offer is accepted, kind of what's next? What are your next steps? And so from the signed contract, from when you and the seller agree on the contract price and all of the terms, from that day until closing day is usually about 28 to 30 days, as Michael was saying. So there's a lot that we pack into those 30 days. And so that is another reason why it's great to go ahead and send over those documents up front, your income and asset documents up front, because it gets us kind of a jump start on this 30-day process. So the first typical part is called processing. So processing is where our companies review the information that you've provided. We're going to confirm the loan program, lock in your interest rates, you sign all of your upfront disclosures, and really make sure that we have you in the right program and have everything perfect. Like Michael said, we're going to look up the property taxes for the house. We'll have all those numbers together. And then depending on how long ago you sent over your pay stubs or bank statements, we might have to update those to make sure they're within 30 days of the loan process, or of the closing day, 45 days of the closing day. So we're also going to do some third-party verifications, verify your employment. We verify some things on the property. We get a flood certificate, talk to the title company. There's a lot of behind the scenes things that happen from the day you go under contract until closing. And so as the lender, that's our job to do some double checking on your behalf on the property and also on your income. The appraisal, like Michael mentioned, is completed during this processing time frame, where again, they're looking for comparable properties that have closed within 6 months, similar characteristics. And typically once we get the appraisal back, we have all of your income and asset documentation, then your loan is submitted to underwriting. So underwriting, they are a specific set of individuals who have usually passed some sort of guideline training, who they're going to take a total look at everything that we've submitted, make sure that underwriting, automated underwriting approval, that we've provided the documents to support the information that we've entered into that system. So they're going to take a look, make sure our pay stubs are within the time frame, our bank statements. They're going to look at the property on the appraisal to make sure that the appraiser has done his job. And they're going to look at the title work provided from the title company. So they're doing a full kind of dotting the I's and crossing the T's, I like to say, of our loan program and of our loan package. And once they give their go ahead and they say that we're approved, then your file moves into closing. So the closers, they're going to prepare the legal documents to make sure that we look to see any loans that the seller has. We want to make sure all of those are paid off at closing, so that the only new loan on the home is your house for the mortgage that you're buying the house with. Make sure that's the only loan. And they're going to finalize all of the numbers to make sure you get the credits you deserve, the seller gets the credits that they're supposed to get per the contract, to finalize those numbers. Now, there are some time-sensitive documents in the process. So the loan estimate needs to be disclosed to you within 3 days of your complete application. So once you have your contract signed and you provide your information to your lender, they need to send you a loan estimate within 3 days of that application date. And then the closing disclosure, that is kind of what wraps us up in the end. That closing disclosure needs to be provided to you 3 days before closing. So that way you have a chance to review the information, compare it to your original loan estimate to make sure that the numbers are within the allowed tolerances before closing. And it gives you plenty of time so that if there are any discrepancies, you've got time to get those resolved before closing. So, your loan company, they're going to ask you for documents, and you kind of feel like a lot of times we relate it to a financial physical, because we're asking you for documents that you're like, oh my gosh, you need to know all of this information about me, but we're only asking you for what's needed. And the reason people ask for it to, ask it to come back in a couple of days is because we're trying to meet these deadlines for you. And we want to make sure we get all the documents to you delivered in a timely manner. So the next screen is really kind of, okay, now you know the process, now you know what's included. How do you get started? What do you do to get ready to buy a house? So the first thing is find a real estate agent. A real estate agent is a great resource because, one, they know the market. They're able to look up homes for you. They can determine if you want a 3-bedroom, 2-bath with a 2-car garage in this neighborhood or school district. They can set up searches for you in those specific areas for you, and they can help go show you homes to get you into that house and help you make decisions on what you want to buy. And they'll refer you to a local lender. So working with a local lender is great because we can help facilitate the whole process with your agent as well to make sure that you're going to close on time and to give you the best opportunity to get your house under contract. You want to complete your loan application, get pre-qualified, or better yet, get pre-approved before you start looking. Because as Michael mentioned in the very beginning, a lot of times what if you start looking at houses in the $250,000 range, but you're not comfortable with that payment, it's hard to back down to a 175 or a 200 price range. It's hard to come back down. So it's better to start looking in the right price range, because you'll have more success and you'll be able to find something that you really like, and that you're, most importantly, that you're comfortable with that monthly payment, because we don't want anyone to ever have buyer's remorse, and to not like their payment. That does not make us feel good. We definitely want people to be comfortable in their monthly payment and their cash to close. So knowing your goals and kind of setting up your budget is really important, as kind of a first step, so that we can help guide you to the right sales price range. And then finally, kind of just some generic do's and don'ts. And when you're starting this process, keep your current employment. Don't change jobs. Sometimes changing jobs, especially if the pay structure changes, can change your loan. So just stay with your current job is the best plan. Stay current on all your existing credit accounts. So if you have credit cards, make sure that you're making those minimum payments. If you don't already, just a really good general tip is to put all of your credit cards on auto pay. So at least the minimum payment is made on the due date. That way you will never have a missed payment on your credit report if you do that. So that's a good tip, just to stay current on those credit accounts. And send in all the documents we request in a timely manner. That just helps the process go smoothly, and it makes it where you don't have a buildup at the end of having a rush of getting documents to us. Avoid making large purchases or increasing your balances on credit cards. A lot of times, I don't know what it is, but when people buy a house, they also want to buy a new car, but that is not a good plan. Do not buy your new car first. Wait until you get the house and then look at buying the car if you need to do that. Try to avoid opening new accounts. Just keep your current accounts, keep everything. Unless, of course, your credit, a loan officer recommends to open a credit card. Sometimes that can be a way of improving credit for people, but don't open it unless you have a conversation with your loan officer. And the biggest one is ask questions along the way. We do this every day. We've been in the business for a long time. And so sometimes we may take something for granted that you understand. There's a lot of acronyms in our business, and sometimes we take it for granted that you might know what an acronym means, or we speak in it and we don't know that we're even saying it. So please ask questions. This is probably one of the biggest investments that you'll ever make in your life. And it's really important that you understand the process, you understand what's going on, because we would never want anyone to get into something that they're not comfortable with. So questions are completely encouraged. I know Michael and I both feel that way. To ask questions, and we're here to help any way we can. Anyway, I kind of think that's all that we had. I guess we'll kind of jump to questions now, Shelby.
Awesome. Yeah, thank you guys. Ricky Smallwood, you've had your hand up for a minute, so if you want to unmute, go for it.
I'm trying to figure out how can I start? Who do I start with? Right now, it took me a pretty good while to save up, the money that I got through a program, and I don't want to lose my money by making a mistake by dealing with somebody I don't even know. Am I dealing with y'all directly, or what? That's what I'm trying to understand. I need to deal with y'all so I know where everything is going?
Yeah, Ricky, I would recommend that you do talk to, Jenny or Michael, or, if you do have a realtor, you could talk to a realtor and they can also recommend somebody. But Jenny and Michael's info will be at the bottom of this, and yeah, give them a call and tell them your situation. And it's often good to talk to a couple loan officers.
Well, right now, you say who I start with, a realtor or what?
Well, that's generally, yeah, we recommend you start with a realtor, and we can refer you to a lender. But since you're here and you've talked to Jenny, or you've heard them speak, you can also go directly to them. It's really up to you.
Yeah, I'm in a program. They kind of pushing it because I've been at this here for about 10 years until I got my credit and stuff picked up. So right now I'm trying to understand, can I go ahead and I need to try to go forward?
That's
So
right.
I'm trying to figure out what do I need? How do I start it? Or who do I need somebody to talk to so they can guide me through this here and I can be comfortable with the trust of them.
Yes, sir. And you can be comfortable with these folks. Write their name and number down. And I appreciate your question. I'm going to answer a couple others, or we're going to have them on there.
I'm trying to
Thank
see
you.
how.
Sorry. Ricky, I'm just going to go on to Karen since we're short on time. She asks in chat, at what point can we get an overall statement on total costs, including closing, etc.?
Yeah, I can speak to that. So Karen, once you talk to a loan officer and they take a loan application with you and they run you through that pre-qualification process, they can send you an estimated cost worksheet or a loan quote that's going to show you total closing costs. So it'll show a breakdown of down payment. It'll then show, origination fees, third-party fees, and then we can put an estimate in there what's going to need to be collected for the escrow account. So you can get that up front is a simple answer.
Awesome. And Nicole Matthews has a question. If you have a collection on your credit report, will that stop you from buying a home?
That's a great question. And no, a collection account does not stop you from buying a home, but it could affect your credit score. So you would definitely want to talk with a lender to have your credit pulled, to take a look to see what your credit scores are. But a collection account itself does not prevent you from a mortgage.
Thank you. Also, Raphael asks, is there a good amount of credit cards to have open?
So, we're not credit experts as loan officers. And so, but I've sat through enough courses and talked to enough credit advisors that my takeaway is it's good to have a mix. It's healthy to have, revolving debt. It's healthy to have installment debt. It's healthy to have accounts that have been open for a long period of time. All those things go into what comes up and how they calculate your FICO score. So I can't really say if it's good or bad. I can say when it comes to credit card debt, it is good to not be maxed out on them, and you will get better scores. The lower the balance is to your high limit. So if they're zero debt, then that's going to help you as long as your credit scores. It won't, never mind how it affects your credit score, but it'll be good when it comes to that debt to income ratio because we don't have to account for any credit card debt. So you have more budget for the house. And
we had, let's see, sorry, I lost my question here. Michelle, we will have this on YouTube, so you will be able to reference it again for sure. And so y'all be able to pause it and write down stuff if you want, and we'll send it out to you as well. So, and then we have the other one will be available as well. Dorothy asked, how does the realtor buyer relationship work? Dorothy, as a realtor, I'll just speak to that. We are happy to talk to you. You do not have to sign a buyer's representation agreement right away with somebody. You can talk to them about, kind of interview them if you like. And we will have a form. There's just an informational form that's called an IABS, information about brokerage services, that will have you look at. And it's just our minimum services that and who we represent. Ultimately, I would recommend you have a buyer's representation agreement so that we work for you and you are our client then. And then 90+% of the time, the seller, the listing agent, the seller and the listing agent, they are paying the buyer's agent to find a buyer. So we get paid by the seller. That's generally how that works. There are exceptions, but and then obviously, and we'll direct you to a lender that we know is or a few lenders that we know are very good. One other question in chat that was raised was about the Fort Worth down payment assistance program. Robert did answer that in chat. It's called the Homebuyer Assistance Program, HAP. 3% of the loan amount may be used for closing costs. And let's see if I can scroll down here. And the remainder for down payment. So, and you can call 817-392-7395 for more info on that. And let's see if there are any other questions. We've answered a bunch and we're pretty much at our time. So I want to thank you guys very much. We'll put up Michael's info on the PowerPoint as well. And like I said, that will be available on YouTube, and we'll send it out to you guys. And we appreciate all your questions. Feel free to give us a call or contact. Robert says the Homebuyer Assistance Program can provide up to $20,000 in assistance. I will say I've had clients use Homebuyer Assistance Programs and come to closing with as little as $800. So they are some great programs. Anything else, Michael or Jenny?
No, I appreciate you guys having me.
Yes, thanks so much.
All right. Well, thank you all. And we'll look forward to hearing from you. And we'll have another program next Tuesday about the, excuse me, taking care of your investment. So hopefully we'll see y'all then.
All right. Thank you.
Thank you.
Thank you. Bye.
Bye.